All right, and finally we arrive at the punchline of this section of the videos, which is the main topic of interest, the accounting equation, as promised. All right, so what are you looking at here? You're looking at basically this is the foundation of everything you're learning in the class, period. That's just the way it is. So what's the fundamental underpinning of this? What's its foundation? Double entry bookkeeping. In other words, we're moving from a system of single entry bookkeeping, which is, the ancient system that was employed, so long ago that I refer to it as, again, accounting for only tangible objects such as currency, wheat, gold, land, goats, and so on, just to give you an idea how ancient it is. So again, double entry bookkeeping is going to make you have to do what? Affect at least two elements of the accounting equation. So you're always going to be in a position where you have to, two things have to be impacted, not just one thing. So that's the big drawback with the single entry bookkeeping system. So just get rid of that line right there. And again, this also allows you to account for intangibles and equities. So that's the two big things that you'll see added to the system because you go from this single entry just tangible object system to the double entry system. But the thing that I think is most important about this is that it creates a mathematical link between everything that you're looking at. And this is a phrase I came up with. You're not going to find this anywhere else in any textbook, which was no islands of information. That's what you're trying to achieve. There's not something over here, there's something over there. Everything is connected, right? But of course, this falls apart if we discuss Enron's fraudulent accounting practices, because that's exactly what they were going for. They were trying to create all these islands of information in order to disguise exactly how poor the company was doing. So if we adhere to strictly what the accounting equation is trying to achieve and some of the basics of like how we define the business entity, then the integrity of what we're doing remains, right? So the accounting equation in its most basic form is right here. So it's got basically three notable elements. So you got assets on the left are equal to your liabilities, which can be called creditor equity, more on that in a moment, plus your owners or stockholders equity. Just so you understand, this element here is exclusive to corporations. So when we say stockholders equity, we mean a corporation. Right, so first, what is an asset? So assets are what? Anything capable of being owned, tangible or intangible. So as promised, intangibles get thrown into the mix here. So of course, obviously, I give you a list of things you could expect to see included here, such as cash, cars, land, buildings, and so on. Just things you would just definitely encounter in business. And again, uncommon things like patents, copyrights, and trademarks. Again, those are all considered intangibles under generally accepted accounting principles. So we'll talk later on exactly, and when we get to account classification, exactly why we consider them intangible. All right, so accounts receivable. Now you might remember we talked about valuing promises, pretty much on par with the actual cash payment. So we abbreviate that A/R. And again, that's what I was talking about. I was saying, if somebody owes you some amount in the future, we call that an account receivable, and that's essentially all it is. It's a promise from a customer to pay you sometime in the future. That's all you're getting out of this relationship, is just a promise at this point in time when it initiates, right? So it's like they're promising to pay you X number of dollars. Usually it's going to be within 30 days is your usual period of time. Now, I do bring up it rings as intangible, right? It sounds like, well, what do you own? Well, I own a promise. Right? That doesn't sound too like tangible, but again, you're not going to see them classified when we do account classification as intangibles. But I like to bring up that it does feel a little insubstantial, doesn't it? And usually this is an interest-free relationship we're discussing when we talk about accounts receivable. Right, so that takes care of the left-hand side of the accounting equation. So we're going to switch over to the right-hand side, and we got two elements to tackle here. So first up is liabilities. Right, so this is amounts owed by the corporation. So this is just representative of any debt of the company. So an interesting thing is what? Liabilities are all intangible by their very nature, right? I mean, think about it. What do you have in your hands here? You have the obligation to pay something. That's it. So the most common liability you're going to see in the class is accounts payable, which is abbreviated A/P. And this, again, is the reciprocal or opposite of that, because, again, now it switches from a promise to receive payment an obligation to make a payment. So you notice it's everything that we talked about in the other definition of AR, but just, switching the point of view. So now it goes from promise, AR, to obligation, AP, but still, it's, again, how long do you have to pay? Well, you have 30 days and usually interest-free. Now, just a little side note, I always love to bring this up. If you take, like, you think about it, all the accounts receivable in the world are equal to all the accounts payable. They kind of have to be, right? Now, not everybody's doing financial accounting, so obviously, from an actual record-keeping standpoint, that's not going to be true. But in terms of the practicality of it, of course, because it's the same, it's just two different sides of the same transaction. Right now, a little bit more about, again, this concept of creditor equity. Why do we sometimes call it that? Okay, let's look at the definition of equity, and that means an ownership interest in an asset or group of assets. So therefore, you can translate it to mean, it means a liability is a creditor's ownership in the business assets. That's literally what it is. It's the portion of the business assets that they have legal ownership of. And if that's true, that means that owner's equity is what? Well, it's assets minus liability. So really, it's just what's left over after the business pays off all its creditors. So that's just the reality of that relationship. Now, terms used to refer to owner's equity for a corporation are common or capital stock and retained earnings. In other words, for now, those terms are going to be the only way that we can identify that we're dealing with a corporation versus a sole proprietorship or a partnership. In the case of those, instead of seeing common or capital stock and retained earnings, you would just simply say, you see a capital account. That's all it would be. That's usually how it's going to be phrased. So just be, so whatever that our one owner is. So if it was my business, we just say Randy Roth, comma, capital, and you're done. So for your business, it would be insert your name here and the blank, comma, capital. If it was a partnership, there would be multiples of these. So for every partner would have their own specific capital account. So it's pretty easy to differentiate one versus the other. So if you see common or capital stock and retained earnings, corporation. If you see one capital account, sole proprietorship, multiple capital accounts, partnership. All right, here's an example of the accounting equation at work. So it's pretty straightforward here when we're talking about solving for owner's equity. So if total assets are 5 million, total liabilities are 1 million, what's total owner's equity? Straightforward, right? So 5 million minus 1 million gives you 4 million. I like to muddy the waters with this typically. So if I change one of the pieces of information here, so I say that's now 3 million instead of 5 million, how does it change? So does it work like this? Do you get to say, as the business that suddenly lost $2 million in assets, like for example, call up all your creditors and say, hey, guess what? We lost all of your assets. We don't owe you anything. Nope. It's good. We're square, right? Does that sound realistic? Of course not. The reality here is that the adjustment would be this way. That goes down to 2 million. So in other words, if things go poorly, who's going to bear the brunt of things going south? The owners are, because whatever you owe the creditors, that's pretty much set in stone. On the other hand, if things go the opposite direction, so now I make this, oops, that's not the shape I was looking for there. Let's try 1 and a 0 there. Okay, so you go to 10 million. How do things change? So this now becomes 9 million. So in other words, if things go well, you want to be an owner now, right? And again, if you had to choose between creditor and owner, and you can do that, by the way, in a corporation, you can choose to be either one of those. In the case of how do you choose to be a creditor, if you're, in terms of a corporation, that would be if you were a bondholder, right? So you can actually buy creditor equity. So we'll talk more about that later. So it's possible to be in that shoes, whereas of course the traditional way of becoming an owner is through stock, as we discussed earlier. So what's the lesson here? More than one, of course. So lessons, plural, here are, first of all, if things go poorly, you prefer to be a creditor than an owner. If they go well, you prefer to be the owner now. In other words, it's sort of a risk-reward thing, because what do you notice is true about the reward for the creditor? It's fixed, right? This is how much they're owed. They don't get any more. They don't get any less than that. This is all they're going to get. So that's the downside. But the upside is, of course, that it can't diminish, right? And here's the other thing. This is like other background information. If you're a creditor and things go poorly, you stand in line first, because that's pretty much well demonstrated in what we've been discussing. So the reality is, so if a company goes under, there'll be a pecking order that gets established. And what you would like to be is you'd like to be a secured creditor if you're in that pecking order. That just simply means that there is a group of assets in whatever the company's assets are that you can point to and say, I have the first claim on those. That's all it means by being a secured creditor. And then there will be a variety of these individuals or companies that have that position. And then everybody else who doesn't have that luxury ends up being stuck in the general unsecured creditor category, which it sounds pretty bad when you think about it. General, when has anything general been good for per se when it's just general is sort of means sort of ordinary in this case. Unsecured, yeah, that has a bad ring to it as well. Unsecured, like certainly you wouldn't want to get into a motor vehicle that was unsecure, right? It doesn't sound like a good idea, right? This is an unsecure car. I'm not getting in that, right? So you're a general unsecured creditor. That means you basically stand in the back of the line after everyone else gets paid, and if you're lucky, you get 10 cents on the dollar, which means what do the owners get? Nothing. They get bupkis. They get zero. So that's if things go badly. Now things go well. The implication here is that your stock value will go up. So when you go to sell your shares, you'll get reimbursed that way. That'll be the upshot there. Because really, the reality is when you're looking at that shareholder equity amount, it really, again, it doesn't represent what people think it does. Because like if the company liquidates, will we get will that be our pro rata share? And the answer is probably not. That's the reality of what you're up against here. All right, so again, that's just the basics here. All I'm giving you down here is just the 7, these are just generic patterns, and the rule here is that they all have to not violate the accounting equation. That means that the equal sign has to remain true, regardless of what you are doing here. Again, this is not a comprehensive list. This is just sort of, think of it as a starter kit. That's all it is, of things that you could observe that are all true. You will see some of these transactions in action in the next video, but some of them you may not. And again, this is just, they can be, in reality, they can be far more complicated than just 2 elements, but again, this is like your minimum requirement. It has to be at least 2 things. So let's just review these patterns. And again, each one of them should make sense. So in other words, this is a legitimate transaction. Increase in asset, decrease in asset. In other words, the example I give is one goes up $1 million and the other asset goes down $1 million, and we see that there is no change in the creditor or owner's equity. Number 2, increase in asset, increase in liability by the same amount, of course. So we see increase in some asset by $1 million, liabilities go up $1 million. And no change here as well, in this case in owner's equity. Increase in asset, increase in owner's equity. So same basic pattern here, except now you'll notice the static element is our liabilities. Increase of liability, decrease owner's equity. So we have no change in assets, but we see we're going to increase our liabilities by $1 million while decreasing owner's equity by the same amount, $1 million. 5th one, decrease in asset, decrease in liability. So again, assets going down, liabilities going down, owner's equity remains constant. Decrease in asset, decrease owner's equity. Same look here, except we'll notice now that it's the liabilities that are constant. And then this one, finally, number 7, decrease liability, increase owner's equity. Again, all of these are legitimate because they don't violate the accounting equation. Of course, that last one, assets remain the same. Right now, got to do a little cleanup here. Gets kind of crazy. All right, so again, answering, whoops, got to highlight that. There we go. Okay, so how do Enron's transactions with White Wing fit into these patterns here? So again, what did they do? They recorded the sale of the assets amounting to, it's like a couple $1 billion, whatever, as if the sale were number 3, right? So they recorded it like this, like, hey, look, our assets went up and our owner's equity went up, because that's what they were trying to achieve here, was an increase in their owner's equity. In other words, to make the company look better than it actually was. But what was the reality? It should have been recorded like this, because it was really just a loan. In other words, yeah, we have more money, assets went up, but we owe every dime of that back. We're going to have to pay it all. So what's the correction here in order to make this proper? So we're going to have to do what? We got to reclassify that money now as actually a liability and take it out of owner's equity. So of course, you can imagine, again, owners are cognizant of and aware of and paying attention to owner's equity. So when they suddenly see that being revised downward, the response is usually going to be what? From the market standpoint, it's going to be negative. And it was this kind of information that really just kept being fed out to the public that led to the utter crash of Enron's stock value. So that was just the reality of what they were up against there. All right, that concludes, again, the first half of the accounting equation materials. Second half, we'll deal with actual business transactions in the accounting equation format, which I will give this away right now, is a learning tool. This is not the actual way you're going to be doing accounting in the class, because as you will see in a moment, it's a bit cumbersome. Bye for now.